This panel is Denver Fintech is on fire. And this is an incredible group of entrepreneurs who are leading the fastest growing fintechs in our city, and is moderated by a gentleman by the name of Ron Suber, who joined us from San Francisco over the course of the last 2 years in the pandemic. But if you know anything about Ron, he's an investor and operator and entrepreneur, and a prolific supporter of all things fintech. He's behind some of the most powerful fintech brands in the world. He's been an investor, he's taken them public through SPACs, he's been an advisor, he's led funds that have led investments in those companies through Series C, through exit. And so you're going to be able to dive into an incredible discussion around why companies like Personal Capital and other leading fintechs have chose Colorado as home, but most importantly, why founders from Maxwell, Sweater Ventures, Nobad, and Cheddar Up are here to really discuss what's happening on our fintech economy. So put on your seatbelts, and I would tell you before Denver Startup Week, I was a rapper, but I kind of always floundered. So I decided that I would be the Denver Startup Week founder. And today we're going to give you a little peek of the best with Denver Startup Week. This panel we have with our moderator, Ron Suber, is about to inspire, and I welcome you to Denver Fintech because it's freaking on fire. Let's go, Ron Suber.
Good morning. Thank you, thank you. Good morning. I loved that last panel. I thought they dropped some truth and some bombs, and we're going to try to do the same thing here today. We, as a group here, would love to have questions at any time. So there'll be roaming mics, raise your hand, stand up if you have any questions. In the crowd, we have students and entrepreneurs and people looking for jobs, people at big companies, people running companies, and you know what this is like. You know this is a tough experience and a challenging but rewarding experience. And here we have three crazy entrepreneurs in different stages of their businesses, in different sectors of their businesses, A round, B round, C round. And so I'd love to introduce them and let them take the show away. They're going to give you some things to really think about that they deal with every day, whether it's in the equity markets or the credit markets, hiring, retaining, and all in between. So let's start with you, Nicole. Tell us about how you did this, the journey, a little bit of what the company does, and where you are today.
Sure. I'm Nicole Montoya, co-founder and CEO of Cheddar Up. We started Cheddar Up about 8, maybe creeping up on 9 years ago, and Cheddar Up is a payment platform. We help group organizers easily collect payments and information. So we work with schools, PTAs, teams, troops, clubs, HOAs, nonprofits to really collect for whatever it is they need to be collecting for. And we're a team of about 19. We've kind of been through it all. We've raised money. We've almost ran out of money. And now we're capital efficient and we're growing a lot. The pandemic was good to us. We've continued to invest in our tech and our platform. We've continued to show up, which I think sometimes is a formula for success. If you just don't give up, you might win. But we really are sort of the go-to platform where our goal is to become a household name for group collectors. And we sort of serve what we call the junior varsity collectors of the world. So if you're a business, you're going to use something else. If you're paying your friend, you're going to use Venmo. If you're sort of that in-between group, you're going to use Cheddar Up.
And Jesse, I know your company's named Sweater, but why are you wearing a sweater when it's 90 degrees out? Don't you have some other swag?
Hey, it was 49 degrees this morning. It was nice.
So you're the most controversial person, the most outspoken person on this panel. Follow this guy on LinkedIn and Twitter. It's crazy to see. He's got the yellow shoes on. Recently funded. Tell us about your journey, Sweater, and what y'all are doing.
Yeah, of course. I don't know if I'm the most controversial person on LinkedIn, but I do like LinkedIn. So Sweater is democratizing access to venture capital. We like to consider ourselves a fintech company that just happens to have a venture fund underneath us. We started this journey about 4 years ago with the idea that we wanted to open up the category, and it took a long time to get an audience with the right people at the SEC, but when we finally did, we identified a fund structure that would let this work, and then we built a technology stack around it. We launched back in June. So as of now, we've got about 5,000 members across the US, and we're pushing to hit about 10 million in AUM right now. We've already made a dozen investments, and we're moving pretty fast. So things are exciting over at Sweater these days.
Awesome. And so when I moved here with my wife a year ago from California as part of the Great Migration to Colorado, I asked who were the people I needed to meet, and clearly Eric was one, and John was another. And John and I have many walks in the park. You're the biggest, most established C-round company up here. Tell this group what you're doing in this really easy mortgage environment.
Yeah, it's a wonderful time to be in the mortgage industry right now. But so Maxwell, today we look at the mortgage industry. There's 20,000 mortgage lending institutions in the United States today: credit unions, community banks, independent mortgage banks, and Maxwell provides software, people, and capital for them to run their businesses. And so today we serve about 300 lenders across the United States. We facilitate about as much volume as the fourth largest lender in the US. Last year, this year we'll probably be number 2. And so just the incredible access to data and the ability to standardize the experience, make it easier, seamless, reduce the cost is a big impact that we have in the market. And we started the company in the Bay Area. All of the founders kind of came out of different startups and tech companies there, and had the fortune of going through Techstars in Boulder, and said, why would we build the company anywhere else? And here we are.
Awesome.
Yeah.
And so I was in the dog park a couple months ago hanging out, and this guy, PJ, was out there with his wife and dog and the kid. And I said, what's your story? And he said, I just moved here from California. I run this tech company. We're venture funded. So tell us about your great company.
Yeah, I guess I didn't get the intro to Ron. I had to find him in a dog park to get his attention. But I'm the co-founder and CEO of Nomad. We guarantee rent for residential landlords and provide them a full sort of financial platform to operate their business on, their home that they're renting out. We were founded in early 2020, raised in the peak of the pandemic. Our pre-seed round just raised our Series A in November, headquartered right down the street in Reno. There's about 40 of us in Denver, about 65 of us across the country. Growing really fast. Hard to drive around Denver right now and not see a Nomad sign, which is exciting. It also means we're not leasing our properties fast enough, so that's a different story. But I, born and raised here in Denver, moved to New York after graduating from CU Boulder, then went out to the Bay and came home where it all began. So fun to be back and building a company here.
Awesome, thank you. Any quick questions for the panelists before I throw another fastball at them? Okay, so the pandemic's, I'm sorry.
Have y'all potentially looked at getting deeper into, especially with some of the new structures in Colorado for organizing DAOs at all?
Organizing what?
Like a decentralized autonomous organization, and so it's especially in finance, it's something that so it just kind of came to my mind. So
I'll jump in on that one. We've looked at DAOs really closely, and that's the answer apparently for DAOs. We think that there's a ton of potential in them, and there's a big movement and a lot of money going into them. I think that they've got a lot to learn. And so from our profile at Sweater, that's not an area that we can play in right now, but we're excited to watch the movement continue to progress and mature, especially on the regulatory front. DAOs are interesting because it kind of lives inside a nice little loophole. And I don't love loopholes because loopholes can be closed, but for its intent and purpose, I think it's very proven around how much people want to be involved in the nature of their investment, and not just hand their money off to someone else, which is something we strongly believe in too.
Thank you. Anybody else? Okay, so Jesse, let's stay with you. So the market's shifting, right? Everything is shifting, whether it's inflation or war or interest rates, et cetera. You're in this platform, two-sided market, venture capital, you have deals and people. Tell us what's happening real time. More people, more deals, better deals, interesting deals. What's happening out there from the Sweater perspective?
Well, it's multifaceted, to be sure. We at first, when the market started correcting, 6 months ago or whatever, we were a little bit concerned. But then as it happened, we realized that it's the best thing ever that could have happened for Sweater, because from our perspective, the market correction allows us to start investing from the bottom of the market. And now we're investing from this kind of lower foundation that we can grow off from. And we're glad that we weren't investing a year ago, because we would have gotten hammered right now. So the behavior from like the startup side as well as the retail investor side. Retail investors, we've definitely feel and have heard feedback that a lot of people are waiting and seeing, and there's a lot of hesitation around what to do and where to put their money. And eventually they'll come out of it. I think that most of us have felt that feeling before, especially recently, of like you're getting hammered in all these different places and there's nowhere to put your money that you're not going to get hammered. So what do you do with it? And so I think a lot of people are trying to put it somewhere safe. Safe is relative, but also with liquidity, where they can, when things do get better and they can see where the market's going, that they can move the money to where it's going to be. But the underlying, I think, trend on that side is absolutely that people want to grab onto their money and control where it's going, what they're doing. That trend is not going away. If anything, it's getting even deeper and more ingrained in people that they want to do it themselves. And so on that side, yeah, there's kind of a pause, and a lot of hesitation, but it's going to, people will come out of it. On the startup side, there's all kinds of correction. I mean, there's tons of great companies everywhere, right? But 2021 was a wild year for funding, and it really pushed valuations through the roof in a way that wasn't sustainable. And I think everybody knew it at the time, but now everyone is feeling the repercussions of that elevated kind of market coming back down to earth. But what's interesting is if you look at the growth trends in valuations from like 2015, 16, 17, and kind of continue what that natural growth trend would have been to now, the pricing that's in the market is still a big increase from the 2016 to 2019 kind of, I guess, area or the growth rate that's there. And so, for us, like, yeah, valuations have come back down to earth, but it's still way better than it was 5 years ago. And some companies are getting hurt from that because they're having to get repriced, but ultimately it's better for the founders, it's better for the investors, it's better for the whole industry. So,
yeah, I think the best summary for last year is either you were a little tipsy or you were blackout drunk, or somewhere in between, but everybody was just a little tipsy last year. So John, there's headwinds, we know about real estate and interest rates, but it's super inefficient, right? Lots of paper, takes a long time, mortgage industry's a mess, hasn't really changed. You're changing it. Like, tell us how you're pivoting in the storm and dealing with all these new changes.
Yeah, and so as everybody knows, interest rates have been rising. As a result, the 10-year Treasury has been rising. The mortgage rates tend to follow the 10-year Treasury, and so as demand for a vehicle like the 10-year Treasury grows, as investors look across the global landscape to see where to put their money, as the U.S. potentially becomes more attractive than some other places, the 10 years are going to continue to grow, and so interest rates are continuing to go up. We're coming off of a savagely unhealthy housing market over the last 2 years, right? A balanced market is about 4 to 6 months of inventory. We got down in the United States to about a month or less of inventory, which was driving all the affordability challenges and house price increases that we saw. We're sitting at about 4 months of inventory right now, so there's a lot more sort of damage that we expect to come from the Fed as they try to rebalance the housing market. So in the midst of all that, our customers are suffering. We've had one of our customers go bankrupt. I was talking with the CEO of one of our clients, and he's like, I'm literally losing money on every single loan I originate, right? And I have to keep originating because I want to keep people in their jobs, and it's a tough time for them right now. And so it's a good opportunity for us to be great partners to our clients, number one. And then number two, I think just like the last 2 years drove structural change for Cheddar, for others, the next 2 years are going to drive that for mortgage even more than they have done, right? Because people are going to realize they need a different structure. You can't run a business on maybe 5 basis points of margin, if that, right? And so we're excited about providing not just the software, but the infrastructure and the capital so that a lender doesn't need to run their own business. They can do it on our platform in their own name, with their own experience on the front end and their brand, but Maxwell on the back end.
So I've noticed you have a little more gray hair since the last time I saw you.
do.
I know I do, but
Yeah.
this is what the markets do to us, people like this.
More gray hair and a few more pounds, yeah.
Right.
Yeah.
Who would you say competes with you or says they do?
Yeah, we compete with individuals across kind of each of the components of our stack, but we're really the only ones that have vertically integrated the entire sort of mortgage value chain. So if you look at the point of sale, you've got Blend, for example, that competes on that end. If you look at the middle, we compete with offshore firms that outsource certain components. And then on the back end, we compete with other investors for loans, where we buy and trade loans for our clients. But nobody's doing that all together, driven off of one core data platform.
And Nicole, how have you pivoted? Payments is hot, it's interesting, it's fragmented. Clearly some big winners out there. What's happening in your world, in your business these days?
As I don't know if I mentioned it or not, but we were, back when we were raising money back in 2015, one of our biggest challenges was, in speaking to investors, was, well, how are you different from Venmo? They didn't really get it. Venmo was taking off, we were starting up. So, one thing we've been super focused on, and we've never intended to be a Venmo, but building our platform so that we're very different from them. So people really understand, Venmo's from person to person, CheddarUp is when you need all kinds of software and you need to collect payments plus information from groups. So we've seen lots of people try to do group payments. Group payments is not a new idea. It's really just the ability to execute on it and build the market. Our market is nuanced. I think the biggest challenge we've had throughout the years is acquiring users, finding that PTA president, finding that troop leader. It's hard, and they're usually slower on the innovation curve, which is why we're seeing a lot of traction now because of the pandemic. Everyone is like, okay, we have to move this stuff online. This is getting crazy. So over the years, to answer your question, we've seen lots of people think they have a brilliant idea, which is solving group payments, realizing how hard it is to build the market and create awareness and acquire users, and then they generally get fatigued and fall off. So yeah, if you were to ask me who my competitors are, sometimes we'll still be in that Venmo lane, but for the most part, we're competing with group payment platforms that aren't doing what we're doing. They're really trying to solve the bachelor party problem, which really does get eaten up more by Venmo. And they're not doing hey, you've got a school who needs to collect the t-shirt size and sign the waiver and collect for shipping. They're not doing that. And so I think that's why we're winning because, I'm a mom, I employ a ton of moms, we know who our target market is. And so as a result, we know how to build software to solve that problem. And then we have a bunch of funny little niche competitors who are really focused on a certain vertical. I think our biggest strength is that we're really flexible. So any kind of group can find us and use us for any kind of thing. If my challenge was, hey, Nicole, go build a software that can help you collect school tuition, for example, that would be really, really easy. But to build a piece of tech that can, be a spiritware store, collect membership, do a fundraiser, that's been a little bit more difficult, but I think we're doing it well. And so I think we're kind of reaping the rewards of that.
Can I make an observation? I was just thinking as a startup CEO, timing is so important, and BJ, you mentioned it as well. So much of what you're doing is trying to look at the tea leaves of what's happening and time your solution to it. For us, when we launched in 2016, the Super Bowl, I still remember Rocket Mortgage, then it was Quicken Loans, launched their push button, get mortgage ad. And some of you probably remember that. And if you went to their experience, it was more like push button, get human being. But that sort of set this expectation now across the market of, gosh, we've got to have a solution where someone can push a button and get a mortgage from me too, from your local credit union, right? And that provided great timing for us to enter the market. And I think the second thing is as the waters are shifting, a big role, I think, of the CEO is to figure out where are the fast waters moving now, right? And how do I take advantage of that or navigate the business into those areas where there's still fast-moving water. So for example, for us, processing, underwriting, it's a big part of what we do for loans, way down this year, right? But that talent actually can be used in other parts of the industry where loans are being traded at a higher rate now in the secondary market, right? PIMCO is selling more loans to Nomura, selling more loans to Credit Suisse. Those loans need to be re-underwritten. It's a very similar talent set, very similar technology. So how do we move towards that fast-moving water during this time? And sort of reading the tea leaves and understanding where to move and how to move is an important skill set, I think.
We say all the time, you can't buy timing, and timing is the control, the one element that's completely out of your control, and it makes or breaks more businesses than any other factor.
Nicole, have you looked at the tipping industry, which is so broken and so manual, this concept of at the end of the dinner, looking at a thing, the lights are dim, you're a little tipsy, how do you tip? Or you're at a hotel and you want to tip the housekeeper, the doorman, you don't have $5 on you, whatever. Have you looked at that? Or not really.
Not really. It strays outside of our core focus, which is groups. So you could do that probably pretty easily with Venmo, and a lot of people do. And there are some platforms that are really focused on that restaurant vertical, and you can check out you can split the tab really great. So no, we've thought about it, but we've consciously decided not to pursue it.
So when you get to be my age, you listen better, and you watch for pattern recognition, and you realize there's truth in humor. And what PJ said earlier was the truth in humor. I don't know how many people heard it. So the waters are shifting. There's a bunch of signs for Nomad around town. How's it going?
Yeah, it's going well overall. We're growing really fast, so there's some growing pains there. But it's kind of a fascinating. I think timing is an important thing for Nomad. So we're in the sort of second or third inning of the institutionalization of the SFR space. So Wall Street is increasingly owning the housing stock of America, which has a lot of implications for all of us. Has a lot of implications for the middle class. Has a lot of implications for how you build wealth here in America. Traditionally, many people have built wealth by owning single-family homes and renting them out. And so Wall Street is getting a big chunk of the pie now. And so, at Nomad, we want to figure out how to empower that small-time landlord to continue to build wealth in this asset class. We want to empower the small-time mom-and-pop property manager to build their business in the midst of all of these new entrants that are venture-backed and growing quickly.
And paying cash.
And paying cash, yeah. And so we have on one side the institutionalization of this space. We have increasing rates, so buying your first home is more difficult than ever. If you could buy a $500,000 home last year, you can buy a $350,000 home this year. And so what we're finding is a lot of landlords, a lot of owners are actually keeping their homes as rentals. Rental rates are skyrocketing. They're locked into a low interest rate. And so they've decided to hold on to their home and continue to build equity, earn some cash flow along the way. And so a lot of owners are transitioning their homes to rentals and using Nomad to guarantee their income over a long period of time. So definitely some great kind of tailwinds in that regard. But it's a tough market out there. And rental rates, it's never been more unaffordable to live in America than it is today. And so we're conscious of that. So there's a lot of things going on, but I think our part to play is to empower the little guy, empower the small-time landlord, empower the mom-pop property manager, help our residents purchase their first home. And so we'll see how it goes. It's we're still 5 million units underbuilt in the U.S., so the supply problems aren't going away anytime soon.
Awesome. Questions? Okay, so PJ, where are all your people, your employees, your teammates, and are you still hiring?
Yeah, we're still hiring. Most are in Denver. Our engineering team is fully remote across the nation. And then we have a few cities launched. So we have Denver off the ground, guaranteeing rent for homes here, Phoenix, Raleigh, Charlotte, Colorado Springs, Boulder, and then we'll be expanding quickly next year. And increasingly, we're rolling out this product through these mom-and-pop property managers, so they can now offer a guaranteed rent program to their customers. And so hopefully we'll be nationwide soon. But most of the team is headquartered here, some people in the field in the markets we operate, and then engineering is fully remote, and that's not going away anytime soon. Our head of data science lives in Paris. So wow. It is a little rough, actually.
That's rough for you.
Yeah, it is, yeah. But yeah, so far we've been doing a hybrid work environment. It's been going really well.
Awesome. So Jesse, you're the newest company up here, right? You're up here. So you're based in Boulder, I think, right?
Yes.
Yeah. So why Denver? Why Colorado? Where are all your people? What was the lesson of this starting a business in the last 9 months? And what were the things maybe the audience should think about, those thinking to do what you did and start something new?
Well, I guess officially, we hit the market in, the last year was when the most was happening. The journey started 4 years ago, and we started in Arizona. And we looked around because we knew, I love Arizona, but we were not going to build this company there. There's no venture capital in Arizona. There's all kinds of reasons why we couldn't do it in Arizona. And we looked around, and we didn't want to be on the coasts. And so we started hunting, and we were looking at, really narrowed it down to the Boulder, Denver area and to Austin, Texas, and ultimately decided that we wanted to be here. And so we moved here, 6 months before the pandemic hit. So I feel like I still don't know anybody because we've all been locked away. But, we came here on purpose because we wanted to build it here. But we also started the company knowing that we weren't going to build it in the traditional way, that there's a new way to build a company and to build teams. And so about half of our team is here, in the Boulder, Denver area, and the rest are spread across the country. Our whole engineering team, ironically, is in Utah for some reason. Like those kind of clusters, they all sort of run together when you start finding engineers that know each other. But we've got people in North Carolina and California and Oregon, and so it's an exciting time to build a company because you can literally access talent from anywhere. But that's also kind of your biggest enemy as well, because everybody else can access your talent from anywhere and offer them just about anything. And so we're excited for the future, and we've been building a culture that we hope is amenable and exciting for people to be a part of from a work culture perspective so that they want to stay. It's not some corporate culture that was started 25 years ago that is now being, hijacked and trying to like create some cool stuff and some perks and whatever. We're building our culture from the ground up so that people want to work here, and that being remote is not a disadvantage, but it's actually just as awesome to be remote as it is to be right here in our office. And it's hard to do. You have to invest in it. You have to be super deliberate, but you can do it, and we feel like we're doing a great job of it so far.
Awesome. John, how many people do you have now? Where are they? How are you keeping them? There's big rumors about layoffs, not only at Google and Goldman Sachs, but maybe in the real estate mortgage industry. How's that going for you as a CEO?
Yeah, so we have about 250 employees. About 80 of those are here in Denver. And then we have probably about 40, 50 in the Dallas area, and then probably another 20, 30 in Raleigh-Durham, and then to BJ's point, everywhere else. So no one in Paris, unfortunately. That would be a good place for an offsite. Yeah, I mean, I think building cultures is a big challenge with a team that size. Getting, there's still employees I haven't met in person yet, and figuring out how to do that is really important. And in terms of layoffs and RIFs, we are watching the market and the market move and making decisions accordingly. We did a small reduction in force in July. Tried to be on the early end of that, of the decisions of companies that were making that, as we were kind of looking at where venture capital was going and valuations were going, to give us the best chance to kind of come out the other side. And so I think any CEO that's not looking into the future and saying, this is my cash runway, how do I make it longer right now to give us the most optionality is making a mistake.
Yeah, from my seat, I see this tale of two cities. There are companies doing their second and third RIFs, reduction in forces, to get to 18 or 24 months of runway so that they have payroll. And there are other companies that are really hiring aggressively, not just in engineering, but in some product areas and some hunting and sales areas. And as an investor, I know that money is being put to work. It's not as dire as everybody says. The capital calls are coming, not just on the specialty lending credit funds and not just on the secondary funds, but some of the primary funds are calling capital. And as I see a venture capitalists here nodding their heads, there are opportunities. We will get through this. I just think, as Eric said, we need to all buckle up and be real about what's happening.
And I think as the earlier panel was saying, right, the expectations have shifted, right? And so, as a later stage startup, we're starting to look at something called net income.
What is that?
Yeah, it's a whole new world, right? And start to think about what is our trajectory to net income next year? Mm-hmm. How do we get there? How do we manage to that number? And that's candidly a new muscle for a lot of startups, including ourselves, that we're being asked to grow. Here's some more capital, drive revenue, top line. And I think, again, to the panel earlier, that's important. It is really important.
Yeah. Nicole, where are your people and what's happening with the team at this point?
Sure. Our team is 19, and we are about 20% of them are here. Everyone else is sort of scattered around the U.S. We have a couple overseas people. We just hired 4 people, which is with a team of 19 is kind of a big addition. We're using new muscles, which is just onboarding and formalizing things, and we've got a few more positions to fill because we are growing fast. My nature is to be more of a conservative leader and grower because of some PTSD with capital raising a few years ago. But it's really fun now. Like, it's really fun to have plenty of money in the bank and be making plenty of money and have the luxury of like, okay, who should we hire next? Let's find the right person. Let's bring them on. But I mean, we live and die by Slack, like I'm sure a lot of companies do, and hiring people remotely is really, we're completely open to it. Frankly, we work better on Slack than we do in person.
Yes, right here. Question in the back.
So it sounds like many of you are transplant
Yeah, I can start. We were lucky. Early pandemic, we were raising our pre-seed round, so raising for mostly angels. The pandemic hit, and all those angels went dark pretty quickly. So we had to get on Zooms with as many investors as we could. We ended up raising 4 times as much as we went out to raising from everyone from the Bay to Utah investors to here in Denver. Range Ventures was sort of our local institution that invested. We found that you can raise locally pretty well through even to the A, but at those growth rounds in Denver, at least, you do have to go to the coast for the growth capital. And so, Silicon Valley Bank, their capital group led our A. And so we did, as things get bigger, we found we will have to go to the coast to raise for the most part. But the ecosystem is maturing, and there's a lot more growth capital, a lot more capital in general in Denver than there ever has been before. I grew up here. My dad was an entrepreneur as I was growing up, and you had to go out of state to raise. There were not a lot of options back as he was founding companies. And so it's refreshing to see the entire ecosystem, from the talent pool to the funding ecosystem, kind of growing up here in Denver.
Yeah, I mean, for us, our angel round was probably 50% Colorado, and that was back, 2015, 2016. Our seed round was probably 20% in Colorado. Our B round, I have to think if there was any Colorado investors in there, right? And so, a lot of the funding coming from the coast at that point, where the check sizes are just getting bigger, and also you start to want larger funds that can carry you through future rounds and be good partners for that next stage of your business. And that takes time to accumulate. And you also want expertise as a fintech, right? I want people that understand how to build a fintech business, have the business development contacts to help us grow. And again, you find those on the coast. And I've had a lot of success in New York, probably more so than the Bay Area from a fintech perspective.
Yeah, our lead investors were out of Chicago for our seed round. So we raised a $12 million seed round, I guess 6 months ago, 8 months ago. And so they were out of Chicago, but we had like 7 or 8 syndicates that were part of that round as well. And so we had one major syndicate that was from Colorado that was put together basically through our own contacts. We didn't go through any of the angel networks or anything here when we did that. And the rest of our syndicates were from all over the country when we did it. So definitely was a lot of raising money via Zoom, which I think is fantastic that we didn't have to fly all over the place and and do meet and greets and waste our time doing that. I mean, seriously, it was awesome to be able to just meet people virtually and go for it. And, I think one note on comments earlier about the amount of capital that's out there right now. I mean, to me, this is sort of a reflection, and who knows what the end point will be, but like the beginning of the pandemic, everybody stopped writing checks for about 6 months at the beginning of the pandemic too. And then you got 2021 where they had to deploy all the money that they didn't deploy in 2020. And in 2021, VCs raised more money than they ever have in the history of venture capital. And all those commitments are sitting behind these VCs. So when they talk about capital calls like coming to bear, that money has to be deployed. I mean, there's I'm sure some weird, back alley sort of deals that could be cut to reduce those kind of obligations, but that's highly unlikely. And so to me, it's a waiting game. How long can VCs sit on all the cash that's burning in their pockets before they have to deploy it? And companies with great fundamentals and who are building something meaningful with a great opportunity, they'll be able to raise money, and they are. We see that all the time. We're deploying checks. And whether they're from inside Colorado or from outside Colorado, being in Colorado is a good place to build a company, and there's good ecosystem credibility that comes from building a company here.
I think the pandemic made it easier than ever to raise money from outside of your network. I'll never forget, I interned for a pretty well-known venture capital firm in business school, and I'll never forget one of the partners told me, this was back in 2015, if I can't get in my Tesla to drive to a board meeting, I'm not interested in investing. This is literally what he said. And so that's obviously very different. I met our largest seed investor for the first time last month. They invested 2 years ago. And so the world is changing really, really fast.
I raised my money, angels, mostly in Colorado, seed round, Colorado, Boulder, and then the seed plus was mostly out of Utah. Well, a couple good funds in Utah. I love Utah.
So let me share one little reminder about the venture capital business. When you sign an agreement as a limited partner to invest, They are charging you on committed capital, not called capital. So whether they deploy the money or not, they're charging you the fees. So while there's a hurry to put the money to work because they want to raise the next fund, they're also getting paid along the way. Nothing against the model, that's the way the game's played. The other thing, this one of the secrets from the coast, seed, family, friends, A, B, C, D, E, SPAC, public, merger, whatever, the big funds, B, C, and beyond, have to write big checks to move the needle. 50 million, 100 million, Sequoia, DST, IVP, Francisco, they can't put 10 and 20 million to work. It doesn't move a $3 billion or $10 billion fund. And so they are all the time calling downstream to the smaller venture capitalists saying, who's growing, who has contribution margin, who's converting, who's going to generate free cash flow or EBITDA or earnings. And the VCs you have today should be pointing you to the ones that are going to lead your A, B, C, or D. And so there's lots of communication and connectivity, and some share better than others. But don't be afraid to go back to your board, your advisors, your early investors to see where and who is calling them to make investments in the next round of those growth companies.
And I think that's a good diligence question to ask as a founder when you're talking to VCs is tell me some stories about companies you've helped raise their next round and dig into that a little bit, and definitely ask for founder references so you can talk to them and validate that how helpful was this investor in making these introductions and getting investors in my next round of financing, because they do play a huge, huge role in that.
Yeah, we have a spreadsheet, our Series A, we know every intro we got and who gave it to us. So we know exactly which investors kind of put in the work and which ones didn't. So, doing diligence with other founders is really important as you're raising money.
Yeah, I've been backed by Sequoia twice. They totally knew where the money was coming from and led us right to it and helped us tell our story. So just remember that one point. So let's get to some numbers if there's no questions from the group. Yes, ma'am, right here.
As a marketer, I wanted to ask you guys, where are you finding customers, and what's been like the most successful programs for you to get acquisition and increase your revenue?
Yeah, for us, we're direct to landlord and increasingly direct to property manager. So it's really, finding those owners that own rental property. So SEM works really well for us, high intent keywords, and then direct mail has worked really well for us. It's cool with direct mail, every address in America, and if the owner of that address lives in that address or not. And so you can take a pretty good guess at whether it's a rental or not. And so we found a lot of success with that channel specifically. And then increasingly
that feels like cheating, just for the record.
Yeah, it does. I actually don't like to tell people about that channel because it has worked really well for us.
For the group, just tell them what SEM is.
Yeah, sorry. So search engine, so Google search has worked really well for us. And then increasingly word of mouth. So you deliver a great service to a landlord, they tell their friends. And then in Denver, again, you drive around Denver, it's hard not to see a Nomad sign right now. It's a green sign that says Nomad, keep an eye out. And so those work really well too. For a business like ours, we benefit from density. So the more folks in a market, the higher our market share in that market, the faster we grow. We think of it as this flywheel, right? The faster that flywheel goes, the further and further we can go in a market with fewer and fewer dollars. So, yeah, word of mouth. That's the name of the game.
What do you give to the person who refers their friend? What's the incentive?
Yeah, it's a little rich right now. $500 today for a referral feels rich to me, but it's way below what we'd pay for that customer otherwise. So
does Sweater have refer a friend?
We have some regulations we dance around that we can't do dollar payouts, but we can give away sweaters. So yeah, we've got a whole merch strategy behind that actually, and you laugh, but I mean it's amazing the number of people that are like, hey, can I get a sweater? I would love to rock your brand. And we've got a whole thing that's going to be hitting soon. But
extra large.
Okay, we got you covered. But yeah, I mean, for us, like we're very much direct to consumer, and we knew that from day one, and we hit it head on. So I think Eric, if Eric's still here somewhere, he said last night he described us as the Dollar Shave Club of venture capital because our videos are very much in that similar kind of vein. Using humor to crack the ice and keep things simple and capture people's attention and imagination, and then pull them into our world where they can discover and where we have a very heavy focus on education and helping people to understand the asset class, because everyone's been locked out. So most people don't understand the nuance of venture capital and how you can actually, how it can benefit you, how it fits inside your portfolio, the inner workings of how the fund actually works, how you get your money back in the long run, all that stuff. And so we bring them in and try to create a community around that. But it's also a difficult nut to crack when you're starting from ground zero, helping someone to understand what is an inherently fairly risky asset category.
Yes, sir.
Property. Oh, sorry. So I always heard that multifamily investment properties are always the best investment properties. Why would someone, as a first-time investor, would buy a single-family property as an investment property rather than a multifamily?
Yeah, there's a lot of reasons. I think one, since 2000, there was no such thing as a REIT, so a big real estate investment trust that owned single family until after 2008. It was kind of assumed that you couldn't institutionalize that asset class. It was too spread out. No two properties were the same. But a lot of technology has been built. A lot of money has been invested in that space. So more and more, it is becoming an asset class that you can own at scale. For an individual investor, owning multifamily is often expensive. Buying a $250,000 single-family home is more approachable than a $2 million multifamily. A lot of people are transitioning their primary home to a rental when they move out and they decide to hold on to it rather than sell it. And so I think it's an easier asset class to get into. And then, they typically appreciate better than multifamily. So there's a lot of reasons to like single-family investing. I think as your portfolio grows, a lot of people will transition into multifamily, they'll transition into commercial, but it's just an easier thing to get into, I think, typically.
Yeah, thank you.
Question.
I have an easy question. Do I have to be actively using Nomad to be an affiliate? Or can I be because I have a website and project where it would partner very well. So I know a lot of people in the fire community who are all about real estate, as you know.
Yeah, let's chat. I'll find you after the, we're working with a partnership with Bigger Pockets, for example. There's a lot of.
Hopefully you talk to Mindy.
Okay, amazing.
Can you tell everybody what the fire community is real quickly?
I'm in the personal finance space, so it's financial independence, retire early, and a lot of those people talk about, and it's huge in Colorado for some reason, it's huge here. So if you've heard of like Mr. Money Mustache and Mindy and the Bigger Pockets crew, and there's a lot of people. So the idea is that you're gonna accelerate your investing and earnings over time so that you can retire early versus working to 65. It's a long conversation. Anyway, awesome. The point is real estate for many of those folks factors in heavily as part of the spoke to get to that 25 times income. So yeah.
Can we bring the microphone right up here, please?
That fire community is Wall Street is slowly but surely chipping away into that community. So I think philosophically there's a big changes in America coming, and it worries me, and I think our goal should be to fight back against that.
Switching back to kind of the corporate culture side, all of you have dispersed workforces, right? It's not a 9 to 5, 5 days a week in a physical space. So I'm just curious how you guys build corporate culture, do things like training, which, as we all know, a lot of that can happen on the job. I personally think that that's the most effective way to train new staff. And you're talking about Sweater and the brand, how you really build a strong brand with your workforce so dispersed.
So I think for us, it starts with our values. And I think one of the greatest aha moments for me as a CEO as we built this business was all that talk about culture actually matters, right? And all that talk about values actually matters. And to start to see your teammates and your other leaders endorse and capture and reiterate and cheer about your values is absolutely incredible. And values become the way that your culture permeates through nodes, right, across Zoom and everything else, right? And so what we had to do was figure out how do we operationalize our values, right? Where do we take our values that we talk about and actually put them into the way we run our business? And so, for example, every person that joins Maxwell goes through a values interview. And so we have a group of interviewers that know how to interview for our values, right? And that, again, reinforces, hey, this is really important, right? When every single person joins the company, we have a session with me or my co-founder that walks them through our values, and we spend an hour talking about our values and how they are part of our business. At the end of every team meeting, we have a section called Gaffes, Good News, and Gratitudes, where we talk about mistakes people made or good news or gratitudes of people living their values across the business. When we do performance reviews every 6 months, you fill out a form that shows, what are the things you did to show rigor, ownership, curiosity, kindness, and straight up in the last 6 months. And so all of those things are just examples of how we try to operationalize our values rather than just put them on the wall somewhere for people to read. And I think I've been impressed, maybe surprised even, how well that's worked to replicate culture. Because you've got this filter where you're bringing in people that are already aligned with that, and then they're replicating it and living it and encouraging others to do the same.
Yeah, I mean, on our side, it's interesting to think about our company with 30 employees versus your company with 250, right? Like, you go about it in a very different way. And for us, it's less about training and it's more about hiring a person for what they can do on day one, right? In a way, like, they're sort of building their job in a way, right? And so for us, it's, there's establishing the ability to have what might be considered like a safe work environment. And we talk a lot about psychological safety and the ability to take risks and to not have fear of repercussion if something goes wrong. I mean, often we talk about like, we're gonna go and summit this mountain that no one's ever gone up before. We can only see so far ahead of us. And in order for us to get up there, we're gonna make mistakes. We're gonna run into things that we didn't expect. And everyone has to be okay with A, taking risks, and B, going into the unknown. And so those are probably some of the biggest cultural things that we are looking for from the mentality of a person before they ever join our team. But before that even, right, it's like the brand building and the ability for someone to understand our mission and find a personal alignment with that is probably the number one thing. If someone isn't passionate about what we're doing, personally, I don't care how talented they are, that person is not going to be a good fit inside the broader culture that we are building, because if they don't have a deep core commitment to that, then it's going to be very difficult for them to meander through this very treacherous path that we're all going to go down together. So I think it's complicated, but at the same time, like, there's things that you can do to make those things more meaningful. So just the last example I'll share is that we do this quarterly on-site, off-site cadence where we fly everybody in from across the country, and on one of them it's on-site and it's very tactical. We're working in cross-collaborative teams and actually building the professional side of our relationships and diving in deep on that so that we have that for the next 3 months as we go out and we work remotely. And then on the other ones, we do our off-sites where we actually leave Boulder, and it's all culture-based, it's all relationships. And we don't actually, work. Like, there's some relative stuff that we do around that, but it's not tactical in that sense. And it's all about the relationship and building that depth. And we go through a lot of different exercises to help us, heighten our relationships with one another at that level on a personal side. So we balance that personal and professional, elements, and being able to bring in that alignment with our mission, and providing that psychological safety to be able to perform in a very ambiguous environment. And I imagine that once we hit 250 employees one day, that our hiring strategies will change, and the way that we have to train and onboard people will change as well. But that's what we do today.
So on this topic, I just drop one thing and then we'll get to the numbers part. And we have about 8 minutes left, so if anybody else has a question, just let us know. So you mentioned the word uncertainty. So when I look at companies or people, especially people coming to venture-backed or private, high-growth companies, it's IQ, their intelligence quotient. How smart are they? How fast does their brain work? How much material can they keep and learn and store? And then there's that EQ thing, like, it's more in your heart. It's your emotional quotient. It's your ability to see nonverbal cues, see who's sleeping, see who has their arms crossed, see who's on their phone, kind of checking the barometer of the room without actually looking at the temperature. You can feel that EQ. And then there's that UQ thing, that uncertainty quotient. Can that CEO or entrepreneur, employee, investor handle this uncertainty, whether it's rates or pandemics or whatever? And then there's adversity quotient. You get punched in the face. It's my favorite movie, Rocky. He didn't have to win. He just had to be standing in the 10th round. And can your employees get up and continue the next round and work with your teammates to try to win the fight. So for me, it's about the Qs. IQ, EQ, AQ, UQ. So let's get to the numbers part while we have time and there's no questions. Each of you are going to answer. Oh, we do have a question. Yes.
My question is about like what you were just talking about, capital, really in the sense of a trend. We saw people like be anxious about investing capital in the first half of the pandemic in 2020, and then we saw the floodgates open last year. We're seeing that happening right now. So the question is about that as a potential trend. So what are you seeing now in place of that capital? Like, are you seeing more private credit or something like that? And then what would you recommend entrepreneurs and founders do now, or boards, that are wanting to get ready for the next opening of the floodgates?
Well, I think it's interesting to dig in. I mean, as founders, I think you find yourself in a variety of different circumstances that ultimately will, I guess, dictate or motivate your behavior. So, I mean, founders that raised at a great valuation last year that are towards the end of their cash cycle and have to go out and raise money, you're going to be in a very different situation than someone who's, just getting started and doesn't have any, I guess, anchor points that they have to refer to, versus someone that might be very, very late stage. I mean, so it's different across the board, so it's hard to answer it perfectly. I mean, we love early stage, and I'd say we're early stage, so, from my perspective, like coming from an area where maybe you haven't raised money before, there's still money out there. It's just going to be harder to get, and it's how hard are you going to work to make that happen? We love SPVs. We think that that's probably the best innovation in early stage venture capital in the last decade, are safes and SPVs. And the ability to be able to move very quickly, to be able to organize interest, to be able to keep your cap table clean, tell a great story, get someone else that's championing what you're doing, and be able to channel all that energy into a single place that's really easy to manage. And there's all kinds of tools out there that make that super simple. And so, to me, like when you're in those early stages, you don't have any other options. You can't go and get private credit and do all this other stuff. So from that perspective, it's going out and finding people that are willing to write a check at this moment in time, or possibly abiding your time as well, right? Because if you don't have anything to grow off from, maybe just wait a little longer too, right? And those are tough decisions. It's so individual for every company that I don't know if there's a perfect answer for that, but in a way, it's like survival at all costs, and it's whatever you have to do to keep the lights on and keep the dream alive.
Yeah, my advice, short of being profitable, very jealous of that, is to just, extend runway as long as you can. Now's not a fun time to raise. Get investors on the cap table who are willing to put more money to work to, in times, when times get tough. I think anytime we think about fundraising, we make sure we've got a commitment from everyone around the table for a certain amount of money so that we can go out fundraising already, signaling that we've got insiders excited about the next round. So make sure the investors on your cap table today are really important. And then, as was said already, put them to work, get them fundraising on your behalf, get introductions, help them, help them help you tell your story. So that would be my advice.
Yeah, I would just say, I mean, it's hard to give you a response. I don't know if it's like your back's against the wall or what, but I would just say there's I mean, it's kind of doom and gloom that's been presented here, but there's definitely money out there. So I would say go find it and keep working on your business, because when things loosen up, it'll be even easier if you're still getting things done.
Our seed round, I stopped counting at 150 investors that I had pitched, right? And I think that's to the points that were already made, right? It's the grit as an entrepreneur to just keep going out and to find the investors that are aligned to your vision, your values, and what you're doing, and not to give up, and to find every way to survive. I mean, we've been through everything, the fundraising journey of raising that much. We've had, a lead investor leave us at the altar with 2 weeks of cash left in the bank. We've had, all kinds of fun adventures over the years, and you just learn, to the points made here, like you squeeze what you can to survive, and you get out to the other side, and there's growth there because you believe in yourself and your team.
So there's
Spend
also
some
this
time
thing.
in dog parks. You meet good people.
Yeah.
Lots of dog parks.
So there is this thing called venture debt, and there's this thing called non-dilutive debt. And you can Google, you'll see, Silicon Valley Bank and Brex and Ramp and all these groups do this venture debt, Signature Bank, and then this whole concept of non-dilutive debt capital that includes some warrants is a thing. And there's lots of companies, I won't give you all the names, but there's I-80 and Upper 90 and CoVenture, and there's a bunch of them, non-dilutive capital, where entrepreneurs can get debt, give up a little warrant coverage, maybe get an equity check, and not be diluted because valuation's not right, et cetera. So those are other ways to do that.
Yeah, we're seeing a lot of activity in the venture debt market. We took some venture debt on in our last round with some great partners at Trinity Capital in Phoenix. Highly recommend them as a team. And you know, they've been great as our fundraising timeline has been pushed out. We're also seeing banks become much more active in venture debt as they see an opportunity to refinance higher venture debt down to lower bank debt rates. So there's a lot of those kind of opportunities that exist today as well.
So we're finished with the letters. Let's do the numbers. What is the one KPI, key performance indicator, that you focus on, that your team is focused on? Top of funnel, conversion, contribution margin, CAC, size, expansion, runway. I don't know who wants to go first. This will be our closing comments. What's the number that these people should think about and understand that you're also very focused on?
For us right now, as I said earlier, it's net operating income, NOI. So I literally have a meeting here in an hour with our senior leadership team to look at how we're performing quarter to date on our NOI targets and
awesome.
What levers we're turning and not turning and that need to be turned to hit those targets.
Awesome.
Ours is really gross margin. We've been tweaking our pricing to really increase that, but something more unique. I just threw that out because everybody has gross margin. But one thing we're really focused on, which is kind of fun, is something that we call payer to collector. And there's a lot of virality built into our platform by nature, it being a group payment platform, and thousands of eyeballs see CheddarUp for the first time every day. So we're really working on how to convert them into, recommending CheddarUp to their group or actually using it to collect for a different group.
Ours is fully burdened payback. So that captures both how quickly you're growing, what your CAC is, what your margin is, how efficiently you can invest in growth. So us, it's payback, and payback by market we launch. And so Denver's payback period is very good. A new market launch might be a little worse, but it encapsulates a lot of important things in growing an early stage business.
For us, we focus a lot on AUM and what it means to get AUM in the door because that's what our fees are attached to. But it's a different way to look at it for us because we have people coming in for $500 and we could have institutions coming in for $5 million. And so there's kind of a lifetime value of $1 that comes in the door for us that we can calculate. And we're playing around with that a lot of how we can actually measure that at different levels so that no matter if someone's putting in a $500 check or a $500,000 check, we can still kind of balance that rather than being overly focused on the cost of acquisition of any given member or user that's inside our ecosystem. That's kind of misleading, and it's not really truly tied to the growth of the company, which is more around AUM.
Awesome. I saw David Sachs on a podcast the other day from Kraft talk about multiples of ARR, annual recurring revenue, and how much you could spend based on what really was happening to your ARR curve. So let me just say I admire you. You are courageous. You are gutsy. And I want to thank you on behalf of everybody here for being open and sharing with us, and wish you all the best of luck. And thank you all for attending. Thanks.